So we have two different variables there that go along with what I previously described. And so if we go back a little bit to the 70s, back then the United States was about 35% of global GDP, and we were the biggest commodity and energy importer. And so when we said, okay, all commodities are going to price in dollars, and everyone's going to use dollars, that was more tenable because we were the biggest consumer and the biggest, currency provider, biggest economy, biggest trade partner in the world. But over time, as we saw multiple countries, starting with Europe and Japan, recover from World War II more thoroughly, become more economically vibrant in their own right, and then later when we saw the rise of China and other emerging markets, the United States steadily declined as a percentage of global GDP, which you'd expect because we're less than 5% of the world population, and so 35% of global GDP is unsustainable. And so we've gone down to about 20% of global GDP, depending on how you measure it, somewhere between say 15 and 22% based on what metrics you want to use, which is still good for the amount of population we have, but it is a much smaller amount. We are also no longer the biggest commodity importer. That's actually China now. And so it's really hard to get the world to use our currency for all global commodity pricing when we're number two in terms of commodity imports. Basically, China's become the world's largest trade partner with most countries. And so we're kind of in this like weird situation where the system's kind of run its course. And so we're still trying to kind of maintain that, even though it's really no longer benefiting from us. And so what we've seen over time is that, when we're running these structural trade deficits, back in the 70s and 80s, you had Europe and Japan. They were the ones running the biggest trade surpluses with us, and they would take those treasuries along with the oil producers, of course, and they would all take those treasuries and they would those dollars. I mean, they'd reinvest those into treasuries, and so they would help monetize our deficits. But as we shifted towards the around year 2000, those kind of saturated. Those kind of reached their growth states, and they weren't rapidly growing anymore. They have much slower growing, aging economies. But we saw the rise of China. And so from the next 20 years, China became the largest trade surplus nation with the United States. And again, they would take those dollars and reinvest those into treasuries. But starting about, say, 7 years ago, China said it's really no longer in our interest to take these dollars and put them into treasuries that aren't really yielding anything anymore. And so instead, we're going to take those dollars and we're going to start investing in hard assets around the world. So we're going to start doing the Belt and Road Initiative. We're going to build infrastructure throughout Eurasia and into Africa. And also, we're going to make dollar-based loans to emerging markets and frontier markets around the world. And so we'll help develop them. But it's kind of mercantilist capitalism because if those countries default on those loans, they tend to be collateralized by real assets. So if Sri Lanka, for example, defaults on a loan to China and it's backed by a port, China gets that port. They own that port now. And so that's happened with railways and ports and commodity deposits, things like that throughout the developed world. And so basically the United States is really kind of getting squeezed here because we're still running these structural trade deficits, but these countries are no longer reinvesting those dollars into American treasuries. They're still investing to some extent in American corporations, but no longer in our treasuries. And so over time, what the United States has is a declining net international investment position. So when we became the world reserve currency in the 20s, 30s, and 40s, we were by far the biggest creditor nation in the world, meaning that Americans owned more foreign assets than foreigners owned of American assets. A lot of that was because we were lending to allies in World War II and World War I, but it's also just because we were a big exporting nation. But ever since this petrodollar system came in place, we've been on the decline because of these trade deficits. And so now the United States is actually the world's biggest debtor nation, meaning that foreigners own more American assets than American own of foreign assets because we've run these big trade deficits. We put dollars into the world, and the world has reinvested those dollars back into owning parts of our debt, owning parts of our companies, owning parts of our real estate. And so so that's like the first problem. The second problem that you mentioned is how some countries are also finding it no longer in their interest. So that first problem described how kind of America is starting to get screwed over now. And so where the second part is about how these other countries are facing problems. And so one thing you see is that currencies are kind of like network effects, and they self-reinforce themselves.
Before we continue, help us by smashing that YouTube like button and subscribe now to this channel. This shows the algorithm that you value the information, and it helps us spread this message. Sharing is caring. Please like and subscribe now. Thank you. And now, let's continue.
And so over the past 20, 30, 40 years, a lot of times when when a entity lends to a developed market, they lend in dollar terms. They don't want to lend in the local currency; they lend in dollars, and that could mean that European firms are lending dollars to African companies or South American companies. That could mean Japanese firms. Again, like we previously said, that could be Chinese companies or governments lending, dollars. It also includes the United States doing that, and so we built about 13 trillion or more in dollar-denominated debt around the world. And most of that is actually not owed to the United States. It's owed to entities around the world, but it just happens to be priced in dollars. But that's creates a problem that if you have the United States declining as a percent of global GDP, and yet the overall amount of dollar-based debt in the world is increasing, that creates a weird dichotomy where there's just not a lot of dollars going out there. Even despite the fact they're running these trade deficits, even those big trade deficits are arguably not enough to get enough dollars out into the world to reliably service those debts, because all those debts represent demand for the dollar. And so that's what a lot of macro analysts have been referring to as a global dollar shortage. And so we started to see and also that also exposed those countries to sanctions, right? So if they have dollar-based debts and the United States says, okay, you're cut off from the SWIFT system, you're basically cut off from the dollar-based system, then those countries are in trouble financially. And so there's been this kind of growing incentive for some countries to begin moving away from the system. And so there's some that are more aggressive in it than others. And so we see, for example, Europe's our ally for the most part, but they still, they built the euro currency. There's tons of flaws with it, but they still wanted to have more sovereignty with their own currency, and so they've unified their currencies. But then more recently, we have Russia, for example, where Russia is obviously one of the nations is not on very friendly terms with the United States. They also have a pretty large military and aeronautic power, right? So they're not easily bullied by global influences, and so and they're a big commodity and oil producer. And so they've actually begun pricing a lot of their energy in euros. And so both their trade with Europe and their trade with China has de-dollarized pretty quickly and has euroized. We also see around the margins that China is using some of its local currency for commodity acquisition, but then also using the euro to some extent. And so we're seeing this somewhat of a decentralization among global countries about basically no longer growing their dollar-based reserves, diversifying their reserves, but then also diversifying the types of payments they use when they're acquiring commodities or other, trade attributes. And so really on both sides of the aisle, both the United States and the world, this current system is just not working out anymore for a lot of reasons. A lot of people, when they hear inflation is going to be transitory, they don't know what that means. And so does that mean that prices go up and then come all the way back down to where they were, or do they just stop increasing? And so, transitory in absolute terms would be kind of like what happened with lumber, where you have this big spike in lumber due to a very specific supply chain bottleneck, and then that gets resolved, and then eventually those prices come back at least pretty close to where they started. And so lumber is actually still quite elevated, but let's say it came all the way back down. That would be an example of truly transitory inflation in absolute terms. Now, that's normally not what happens. Instead, what happens is that a lot of money supply goes in the system, and you have these constraints. You have more people have more money, prices go up, and then it might be a time where they, basically maybe fiscal situation changes or bank lending changes, and the money supply stops going up at that rate. And so eventually prices start to level off, but they don't go back down. And so inflation kind of is transitory in rate of change terms, but it represents a permanent stepwise increase in the general price level. And that's because it wasn't just due to specific supply constraints, it was due to a broad increase in the broad money supply. And so if you look at the 40s, you had these three really big spikes in inflation. Inflation would go in the double digits and then come back down to zero, and then go back in the double digits. And that was a combination of rapid money supply growth and price and wage controls, things like that. But if you look at the absolute CPI, you'd have a stepwise increase in prices and it would level off. Then another stepwise increase and level off. You didn't actually go back down to the original price level. And so I think that's what we're going towards in the 2020s, where inflation doesn't necessarily just keep continuing, accelerating every year. You might have these periods where it levels off or goes down a little bit, but the general price level is likely to keep having these stepwise increases over time.
What to do in such a situation? Inform yourself and keep your financial education strong. We from the Compact Group offer our loyal subscribers a free educational portal with first-hand monetary, financial, and economic knowledge. Enter our invite-only Insider Club by clicking the link below. You will get access to first-class information far earlier than the rest. we have prepared a special deal for all our members where you can access a giant pool of Robert Kiyosaki's financial wisdom for just $1. To find out more, simply click the link below and join our Insider Club absolutely free. But there is more you can and should do. Build up several streams of income. More and more people realize that they have to take their future in their own hands, but they don't know how and where to start. We from Compact offer our Insider Club members unique opportunities. Strengthen your financial muscle and get the edge. Click the link below. Become part of our free Insider Club. No financial obligations. But there's one important thing you have to know. You have to become active. So do it now. Become active and see you on the other side.